Hello and welcome to this fireside chat of the Center on Regulation and Markets at the Brookings Institution. My name is Sanjay Patnaik and I'm the director of the center. In our series of fireside chats, we explore important topics related to modern-day markets and regulations through one-on-one conversations with regulators, business executives, and academics. Today, it is my real pleasure to welcome Bill Tai, who is a renowned venture capitalist in Silicon Valley who has been involved in 22 IPOs. Bill established a semiconductor practice at Alex. Brown & Sons, positioning the IPOs of Atmel, Cirrus Logic, Dallas Semiconductor, and Zilog. He's also the co-founder and chairman of Treasure Data, the founding chairman of IP Infusion, the chairman of Hut 8 Mining, which is North America's largest publicly listed Bitcoin mining operation, and the founding chairman and CEO of iAsiaWorks. He's also the past board director of 8 publicly listed companies. And interestingly, he's among the very first investors in Canvas, Color Genomics, TweetDeck, Twitter, Wish.com, and Zoom, and also on today's topics in NFTs. He's also been an early proponent of P2P currencies and created the Necker Blockchain Summit. He has an MBA from Harvard and has an honorary PhD from Curtin University. Thank you so much, Bill, for being here today. It's a pleasure to have you.
Thank you, Sanjay. Excited to be here. Fun topics.
Definitely. And so NFTs, or non-fungible tokens, are really being talked about a lot in the media in the last couple of weeks, right? The frenzy was kicked off with that NFT tied to an art piece, an art collage that sold for almost $70 million at Christie's. And I just read today that there was an NFT tied to one pixel that sold for $1.4 million. And so for people who don't really know what is an NFT, can you just try to explain what are non-fungible tokens? How do they work?
Yeah, so non-fungible tokens are basically uniquely authenticated items that are expressed digitally, whether they are a physical or a digital item, to a marketplace. And that marketplace is going to be a community of interests where the economic interests of the community are aligned. And it's a little bit like a charity auction where something that might sell for, a regular price on the street, embedded inside an emotional community that's engaged around a product or an issue or wants to be seen, for ego perspectives, will pay up for something because it expresses their position in the community.
So it kind of like can be seen as an authenticator for digital items. If we take the analogy for like a regular painting, maybe you have an art expert that comes in and says, oh yeah, that is a Picasso. With an NFT, you would know actually this is authentic from the original creator. Is that correct?
That is part of the equation because, part of the value comes from knowing that it's the real deal. Mm-hmm. The other part of the value becomes its low friction expression to a community of interest that is aggregated into one place. In this case, kind of the auction market. Mm-hmm. And, I have a tale of, how I got, kind of my head wrapped around this. I happened to get involved in the Bitcoin ecosystem in 2010. I was Alan Greenspan Gollum in Second Life when in 2001, Philip launched the Linden dollar, which was one of the first free-floating digital currencies in its own economy. Mm-hmm. And that led me to, being introduced to the Bitcoin white paper around 2009 and 10, and I started mining in 2010. And that led later to me pulling together a summit on Necker Island that involved Richard Branson, of course, mm-hmm. called the Necker Blockchain Summit. And we tried 5 or 6 years ago to find projects that would involve Bitcoin and blockchain for social and environmental good. And we built it around an economist named Hernando de Soto, mm-hmm. who's famous for writing the book Mystery of Capital. And so that book is about the kind of granularization, authentication, and low friction expression of land titles. If you think about it, it's kind of like, how do you make land titling the basic building block of capitalism? Yeah. Low friction, replicable, scalable. And that led to basically an NFT architecture that we put together 5 or 6 years ago. That's how I got involved in it first.
Oh, that's really interesting. So that's how the NFT wave started?
No. Well, I don't know that there is a starting point. In a way, NFTs, you can equate them with barter. So I think the idea of a unique asset being traded for another asset, whether it's a fungible or not, currency being fungible and other items being not, That's been a part of human history ever since man could think about, things as assets. So the digital wrapper part, that's a little bit more recent, but I'm gonna stretch your mind a little bit to abstract it from where we are today, where it's becoming more commoditized in a way and lower friction, therefore, easier to buy. If you look at Uber or Airbnb, those are essentially software platforms that allow a car and driver to become an NFT, where the
that's interesting. I never thought about it that way.
Yeah, ownership trades for 5 minutes, and it's low friction to execute that transaction. Airbnb is basically a data cloud where apartments have been turned into digital tokens where people can buy and sell them at ease, right? So that's really not that different in some ways from other travel sites and other things, but the marketplace function has changed everything. And so if you look at, I'll give you another analogy. If you think about the beginning of the internet, before the internet became this widely adopted mass standard on TCP/IP, you had private functions doing the same thing in smaller private networks. You had AOL, CompuServe, Prodigy. That today is the Uber and Airbnb, right? If you were going to start those companies today, you can't take away their market, the community and marketplace that they've built, but you might start the technology platform as an expression on blockchain, and it'd be easier to build as an open standards kinds of thing, like you would build on the internet, instead of having to create your own cloud as AOL did.
Interesting. Can you talk a little bit about how the technology behind NFTs works? It is tied to blockchain, right? So how does it work? How does it get authenticated?
So in this case, so in the more modern expression, I'll give you an example. That the market share leader is a company that I was an angel backer of called Dapper Labs.
Okay.
I don't know their run rate today, but as it was zooming up over the last, they launched the platform called NBA Top Shot about 9 months ago. As it really started to catch hold this spring, it kind of zoomed up to $14 million a day, $5 billion of GMV, annualized run rate transaction. That authentication takes place because Dapper Labs partnered with the NBA, which had libraries and libraries of film footage from their games, and they themselves were the arbiter of what's authentic and not authentic, right? And in this case, they packaged things that they owned, so those were truly authentic. And so in every vertical marketplace that would be, quote, NFT'd, you're going to have different sources of authentication. The Beeple transaction was handled by one of the main auction firms, like a Christie's or a Sotheby's. They're responsible for the authentication. And then the expression of that happened to happen on blockchain, in this case, Ethereum. If it's done on Dapper, it happens on the blockchain that they introduced called the Flow blockchain.
I see. Okay, that's interesting. And so one thing that I was wondering about is, let's say you are the investor that bought that NFT attached to the painting for $70 million, right? What is the value that you get out of it? Because that painting can be replicated a million times over, right? People can download it, they can put it on their computer screens, they can print it out. So what is the value to me if I hold that NFT?
It's the knowledge that you hold the original deal, and that there are, quote, authentic reproductions all over the place, right? So if you think about, I think the basic behavior is not that different than baseball cards from Topps 20 years ago that still exist today, right? So if you think about how that human behavior has evolved, that it is a known behavior that's been around for many decades. There might be multiple versions of a baseball card for Babe Ruth. There might be 100 of them. I don't know. It's fungible, but kind of non-fungible because they're limited edition. And you have people trying to collect them because they want to complete a set, or because they have an emotional attachment to a player from a certain team. And so to some people, you're going to have higher value attributed to an item than other people. And so it's a marketplace function to let that good seek its way to where it suddenly has value, right? And so in a way, it doesn't matter how many of them exist, but the scarcity value adds more.
So it's really the knowledge I own the original one, and so whoever copies it, it's a copy. Okay.
Right. And
so what does originality mean in that context, right? Because it's digital. So
yeah.
Can you explain that a little bit?
Yeah. Okay. So this is where I think there's kind of a profound change in the way value is attributed to items in the modern world. In a way, in the old world, you would want the physical item, you might stick it in a frame and stick in your house, and you want people to know that you own it.
Yeah.
But the ability to let people know that you own it is kind of limited, right? Because it's in your room, and you'd have to find somebody to take a picture of it and print it in the newspaper and say, oh, Sanjay bought the Babe Ruth card, he's a player, right? And now it's all over social media. So now the cost,
that's interesting.
The ability to drive attention has gone exponential, and therefore sort of the ego part of I'm the owner of the $69 billion Beeple thing, I must be a player. You know, it's totally revolutionized the way people think about community, position in community, and alignment of interests of people around items.
That's actually a really interesting point. I hadn't thought about it. So it kind of like bestows social status to a much broader audience, right? Instead of like hanging your Picasso at home that a limited audience would see, everyone knows that you own the NFT. That's interesting.
Yeah, and I'm going to use another analogy. You know, when I was trying to explain this, so Hernando de Soto, he's got a big brain, and he thought through, you know, the roots of capitalist societies and why capitalism works in the West but not other places, and how by lowering the friction to land title, you had a really productive economy because people could borrow against that and invest in other stuff. Where if you don't have clear title, can't do anything. So the unit of capital just didn't exist, right? And I was trying to explain blockchain to him and marketplaces. And I said, look, Hernando, it's like this, because he had told me that he had just bought a rug through Mercado Libre, which is the South American kind of equivalent of eBay. I said, Hernando, okay, this is what's happening because of digital and marketplaces. That rug, before it was listed, was worth zero. It was sitting in someone's garage. No one knew it even existed. The guy wanted to get rid of it. It was a piece of trash. Well, it was a good piece of trash because he paid a lot for it. But once it was authenticated, because the person wrote about it and put it on in Mercado Libre with pictures and said this exists, and expressed to a broad marketplace, suddenly that item went from zero to thousands. So there was this great value creation because of the lowering friction of the digital expression broadcast to a very wide market. If you contrast that to a first generation marketplace, a flea market, how would the value be created there? The guy would have to take that thing, load it into a truck, drive it to this thing where a lot of people showed up one morning and hope that somebody walked by his table and said, I like that rug. You know, so the friction to accruing value is very high in the physical world. It's lowered greatly in the digital world, and the audience reach is exponentially like 1 million times bigger. So anytime you have marketplaces where you can reach more people with lower friction, you're going to have higher value because there's a higher chance that that item matches the person with interest.
So you can really expand your value of items that you put out on the market because they're socially constructed based on the demand in the marketplace, right?
Yes, and digital allows you also to pull into one place a fervent community of interest that is excited about that type of topic, right? So if you think about NBA Top Shot, why does that work? Because there's a lot of people that like the NBA and they're drawn into one cluster. So the granularization of marketplaces to verticals, it's like you go to eBay to look for something. You can look for rugs and find the categories as rugs, you know, instead of walking to a flea market with 80,000 items in a football field, trying to figure out what's there by who.
That's actually really interesting. And so when you look back at how NFTs have evolved over the time, who are the people that usually have invested in those and have advocated for them? And who do you think should invest now that it's becoming a bit more mainstream? Is that something that is for the mainstream investor to actually maybe put some value in there? Or again, only for like very dedicated communities for certain products?
I look at it as, again, a lowering of friction for the economic alignment of interest across communities of interest.
That's
so just like there are clubs that trade old cars, and specifically clubs that trade old Mustangs
Mm-hmm.
or people that collect art.
Yeah.
Now there's potentially a way for all of the items out there in the world someday to find their way to specific clusters in the same way that people have found their way to specific clusters through things like Facebook groups or prior to that Yahoo groups. So I myself as a kiteboarder,
Yeah.
had I started a kiteboard in an era where Facebook didn't exist, I might have had 5 friends in California that I do that with, but because of the reach of social media and the ability to place attributes on what you do, what you're interested in, other people can find you. So now I have a network of thousands and thousands of people that do what I do that I go see when I go travel. So it's a great liquefaction and then of community, the disaggregation and then reaggregation into clusters that matter to you. And that's happening in commerce and NFTs.
That's actually really an interesting aspect, because you can think of it about kind of like facilitating the global marketplace even further than what we have seen in the last couple of decades, right? You really have a global market, and you can find the communities and the different sub-target audiences that you are looking for your product.
Yeah, and on that note, you can make an analogy that NFT clusters are not any different than loyalty points, right? So if you think about what is a community of interest around a brand that has its own loyalty programs, whether it's an airline mile or a Starbucks point system, right? You have an affinity for that brand and cluster. You trust that brand and cluster. They're the authenticating entity around a fungible token in this case, sometimes non-fungible, but that becomes a unit of exchange of value. So it's been happening ever since humans have been around.
So it's an old idea with a new twist to it. That's really fascinating. And so one thing that I saw this week is that I read an article that NFT prices are currently crashing. And so I'm curious, like, the market, well, did you expect that? And what do you predict for the NFT market in the long term? And especially, do you think that NFTs might become a bubble, or do you think it's going to set up into an equilibrium again?
Every sort of mass realization that something has value creates this quick, fast spike of onboarding that, goes into this sort of, excitement phase that then, may fitter out a little bit, but a lot of things are durable from that. It's kind of like the IPO placement of something that, people are crazy about in the beginning, and then they realize, wow, I know it's going to work, but there's no business model, and it comes down. Now, in this case, there's a real business model. That's the amazing thing. You look at Dapper hitting $5 billion of GMV in 90 days.
Wow.
I don't think I've ever seen a company grow that fast in my life.
So
part of it was a little bit of this, bubbly uplift, but bubbles, what is a bubble? It's prices are where supply meets demand. And at that moment, demand far outstrips supply. And so it'll settle and more supply will come on, as you've been seeing. And therefore the demand starts to distribute itself across that supply, and you get this equalization point. Can't predict the price. You just know it's going to go up and down.
Okay, that's interesting. And one thing, when we try to think about it, the new technology here at my center, we always think about the intersection of markets and regulations, right? And so when you look at NFTs, I'm curious, do you know if NFT trades are taxed anywhere in the world currently? And what is your view on that? Should they maybe be taxed or not?
NFTs, I am not a lawyer and not a regulator myself, but I think, because I've been around the space, I think the way it's looked at, I'm pretty sure the way it's looked at is that they are treated like commodities.
Okay.
Meaning that if you bought an item for $1,000 and then you sold it for $10,000, you made a gain on that asset, just like you would have on your house or a car or anything else.
Okay.
So you'll owe a capital gains tax on that item, and the rate of tax is going to depend on your jurisdiction and the classification of the item.
So then, actually, do you think regulators would need any different approaches to NFTs, or even broader thing about blockchain, to regulate those? Or do you think if we can think about them in the case of NFTs, it's just regular assets, we don't need any new approaches to that?
It's a question of how close the NFT. So long as there's the N in the NFT instead of the FT, fungible token,
That's a good point.
It's far easier to make sure that it's not classified as a currency.
Okay.
Because it is a non-fungible unique item. The closer it gets to a fungible item, interchangeable, like, let's say you had a quote NFT that was one of issuance of 1,000 copies, or one of 1,000,000 copies.
Yeah.
Then you start getting into this era of, well, is it an ICO? Is it a tradable item? And those may or may not be treated differently. At the extreme of that argument, if you were to look at digital currency and it's not classified as currency, it's classified as a commodity, every Bitcoin, in a way, Bitcoins are a subset of NFTs. Now that's going to be like, what did he just say?
Can you explain that?
Yes. Okay, so every Bitcoin is swappable for another Bitcoin in a sense, but it's a unique item. Every single Bitcoin has its own identity with a different address, just like a dollar bill has a serial number that's different than the next dollar bill. So every dollar bill is an NFT, but it is fungible, right? So because there are other units that are interesting. So the closer you get to currencies, then you enter this other regulatory question or dilemma. Do you really want it to be low friction? And if so, like, if you and I are trading around stuff for Swiss francs in the United States, we don't pay tax on that. Like, if I went to Switzerland, came back with some Swiss francs and the exchange rate was lower, and then I bought that jacket you're wearing from you by handing you some Swiss francs, I don't pay a capital gains tax on the delta between the Swiss franc at where I bought it and where today's price is if I changed it for that jacket. But in cryptocurrency, theoretically you do. But it's very hard to figure out, like the accounting overhead for that. Everyone just ignores it, because it's too hard to track. But that's the regulatory question for you guys. Like, if crypto is going to be important to this world's future, and if America is going to continue to be a player in it, we can't have the highest friction system in the world, right? So at some point, if currencies go digital, I think it's important for Brookings to make it clear from an academic and regulatory standpoint that it's better for America to do what it's always done, to be the place of low friction to drive innovation.
And I think you would probably need an international agreement on how to regulate those, because it doesn't make sense to do it in different jurisdictions. I think it's an interesting case of which we see in a lot of other areas where you have basically a global market, global technology, but you have regulatory agencies that are tied to domestic, to national borders, right? And so that's quite inefficient in many cases. So it's always better to have some cooperation on there to come up with a common framework.
Yeah, it's going to have to happen.
Yeah, I agree. And so when we look at another aspect, which is intellectual property rights protection, right? How does that play into NFTs? Can NFTs maybe help with that or the authentication? I'm curious.
That's going to be a question of, because if someone's going to launch an NFT, let's take a category where you're starting to see some activity that has been kind of IP based the whole time, which is music, right? So if you think about the various layers of music, you have the publishing rights, you have the copyright rights of the person that wrote the song, you have the performance rights, you have the, there's like 5 or 6 different possible layers of rights that all have to come together when a song is either sold or streamed. And so it's been historically a very clunky process where lawyers at Universal or Sony or Warner Music work out something with each individual artist. And then sometimes the owner of one part of that might sell part of the rights, so you've got suddenly a split, and it's not just one person managing everything, but, Universal owns the publishing, the Guns N' Roses might own the copyright to the songs. Like it could be all over the place, and you got to synchronize all that stuff again. And so things get pretty complicated. And so what you're seeing today in the music space is that there's going to be some launches where you get the whole stack of IP, some that are just carving out the masters, some that are carving out just the copyright. And then it's interesting then the right to stream those. I think it's going to go to a point where people will sell the item and the economic rights that go with the item later, where today they're selling basically what, like the baseball trading card, right? You don't sell the baseball player, you sell his picture on a piece of paper,
Right,
and
yeah.
that's worth something. But eventually you might sell the song with all of the royalties forward going and that item, like David Bowie did when he sold his bonds.
Oh, that's interesting. So that has really the potential to shake up a lot of industries then, if we see more of that.
It could redefine industries based around IP, no question.
Wow. So another question I want to talk to you about is a little bit about future technologies, right? So you have been at the forefront of investing in future technologies way before they become hip and trendy, right? You were one of the early investors in Zoom many years ago, and now all of us are using it in this unprecedented COVID-19 world. And so similarly, kind of like NFTs is one example where you already saw it early coming. How do you assess as an investor whether a technology or a company is likely to be successful? I mean, that's the million-dollar question for any VC, right? But I'm curious what your thought process is. How do you go about it?
You know, I had the great pleasure of being at the first startup I joined. I had a board member on there named Don Valentine. He was the founder of Sequoia Capital. And people in the venture business, you know, Sequoia, because it's the one that really over time, it was a little firm at the time, but it became the real player. And you know, Don himself was the backer of Apple, Oracle, Cisco, Network Appliance, LSI Logic, Electronic Arts. So that's probably 1,000 billion on 7 companies, you know, and then the firm went on to fund Google and everybody else, right? So in my very early days, we were both investors in microchip technology, a good, you know, $100 billion market cap company today. And we were stuck at an airport in Phoenix after a board meeting because our flight got canceled. And in my young pup days, I was like, so Don, what do I have to do to be good at this? And Don, and everybody that knows him knows he's a very terse person.
Okay.
He says, it's really quite simple, Bill. You only have to get 3 things right. You know, get the right market, get the right person in place, and don't overpay. Okay, so now I know that sounds extraordinarily simple.
Right.
Then he followed that up with, make sure it's a really big market. And he said, he said, if you think about it, it's obvious. You take a big market and a couple of good people, time it right, don't overpay, you're going to find every time. You take a shitty market and an A-class team and infinite money, you'll lose money every time.
Yeah.
So my view on that has evolved to really one about market size, timing of market on some disruptive change, the right rider, and it's a lot like surfing. You know, so if you think about, you know, surfing, you're sitting out on the water on this board, looking backwards at some waves coming, and all that really matters is when you paddle and if you paddle, right? So you have to pick the right wave, because if you pick the wrong one, you just waste your energy and it was a zero.
Yeah.
If you pick the right wave, you might paddle at the right time or not. If you paddle at the right time, you only have to paddle once, right? So it's a very efficient expenditure of energy and you're on the wave. So I've been around doing venture now for 30 years. So I think over lots of wins and losses, I just have developed some instinct about what's coming down the pike. And usually if I think of something myself, I have to say, okay, stop thinking about it for about 7 years. And then that's when it'll hit, you know, so somewhere between now and then I have to find the rider. And if you pick a great rider, like an Eric Yuan at Zoom or Melanie Perkins at Canva, you're going to do great every time.
And I think I would imagine the challenge here is also to assess what market is there potentially there, right? Because a lot of these markets don't exist yet. So if you look at market size, you have to try to assess what is the potential market size. I mean, smartphones, right? Like before we had smartphones, the market was much more smaller and people didn't know that they actually needed that kind of technology.
Yeah, so some of it is basically looking at the underlying foundational technology and the impact it will bring to other markets it serves and when. And I think I kind of tuned that. My original experience was actually designing silicon chips. And so a lot of the stuff that I worked on ended up in products later. And you could see the impact of being able to take a whole bunch of stuff and putting it onto a little chip in reducing cost, expanding the market greatly, really making use cases easier and therefore a lot bigger. And so as I look at the things that I do tend to be a technology disruption that is applying itself to a market that is pretty big and kind of inefficient, where you can just see the obvious impact. That was the case with Zoom, with cloud-based video. That was the case with Canva, cloud-based design. It was the case with Treasure Data, cloud-based Hadoop. So all the investments I made that really hit at that time between kind of 2010 and 2013, 14 were a question in my head of how will the cost structure change in major businesses by taking what they did and compressing it into cloud infrastructure and mobile expression at the endpoints.
That's an interesting angle to look at, to really see how it affects the current industries. That's great. And so another question is, when you look at entrepreneurs, I think oftentimes when you look at Silicon Valley, many times regulatory issues are in the kind of like the back of the mind, right? I mean, these entrepreneurs, they have to deal with so many issues. But how important do you think it is that startups engage with regulators on their potential products early on? I mean, if we look at things like Lyft and Uber, right? Those kind of like went into markets without worrying about regulators too much. And then they ran into headwinds, both in the US and in Europe and in Asia. So what is your experience? How important do you think startups should think about these issues?
I think they have to be aware enough of what the regulation is at the time, but they have to have a healthy disrespect of what those rules are. Because if they respect the rules too much, they're never going to try, right? If everybody that started those companies knew everything that they were going to run into, they probably wouldn't have done it. And Coinbase is another example. Right? If the folks that started Coinbase sat around thinking about the ways the government might be offended or threatened and try to, dampen their business, they might not have ever started. I don't know that, but I'm just presuming that they were very much religious zealots, so maybe they would have started it anyway. But I think it's important to know what the rules are. But if you bring great efficiency to a market, and a service that people want, in the end, at least in a democracy, the people using the services elect the regulators. So it takes a little while for the cycle to take hold. But if everybody's using Uber, the government that tries to shut off people's transportation, they're going to get voted out.
So it's really pushing the boundaries of current regulations and adapting them to new markets, right? Because I think oftentimes even regulators, when I speak to them, they have the challenge of not really knowing how to regulate some of those new markets and products. And I think ride sharing is a good example for that, right? It completely changed the transportation industry, the taxi cab industry, but it pushed the boundaries of the regulatory framework that was in place previously.
Yes, and I think, the ride sharing thing is big.
Yeah, but still is. The debate is going on, yeah.
Yes, but it's infinitesimal in impact compared to the world of currencies. So I think, the regulatory questions, issues, answers, battles around monetary systems are going to be mind-boggling compared to the little smaller marketplaces that are big themselves, that are being addressed now.
And I think that's really a lot of the key to good and smart regulation that we also work on a lot, right? It's finding that balance as a regulator to correct potential market failures, which regulation is here for, but to make sure you don't stifle innovation for products or new ideas that could actually improve efficiency. I think that's an interesting tension. And I'm curious, does the VC community at all support startups in their consultation with regulators, with thinking about those political aspects? I think what we have seen, at least in the last 10 to 15 years, I would say, that tech companies historically have not engaged much in Capitol Hill, but they are much more engaged now. I think they realize that some of those battles are quite important. And so I'm curious how that debate is being framed in the VC community and among startups in Silicon Valley.
It's always a very late realization when you have it.
Yeah,
and I think and it's also over time, it's become more important when those late realizations come than before. So, you know, if I look at the evolution of Silicon Valley Silicon Valley style venture capital as a series of waves of technology.
Yeah.
And they really started more business to business and now are becoming very heavily consumer. But, you know, in the days of Silicon, all you really wanted to do was deliver a product that was better and faster and cheaper and more reliable that did a lot for less money.
Yeah.
And then that found its expression in computer and communications equipment. It revolutionized networks, telephone networks from the inside out. And that's where regulatory issues started to crop up. I think in the mid 90s, as I was working on a lot of stuff in communications equipment and internet networks, there was a lot of confusion about what would the government and regulators do about the structure of telecommunications and the rates at which the phone companies could charge the internet providers. And our internet providers, our ISPs, phone companies, or not, you know, because they're selling packetized data services like voice over IP on top of the phone lines for lower prices, you know. So it was a very confusing period, and a lot of the swings in market cap of the public companies depended on what would the FCC say. You know, so that's when we started to hit consumers at mass scale in digital technologies. And then as the internet started, as the venture investing started to move to the overlays on top of the internet, so Facebook, Google, LinkedIn, things that ran on them, it wasn't until those things hit, you know, mass adoption points and that we started to hit these like questions of privacy and questions of fake news and things where regulatory good governance is very important, and it's becoming increasingly so because you could swing elections the wrong way. You know, so I think as we now move forward even more to consumers being touched by technology every single day because of the smartphones and networks, and the delivery mechanism is so easy now for everything, that we're going to start to hit the regulatory issues much sooner, because these companies can go from nothing to 1 billion users in a year, theoretically, where it would have taken 20 years in the old hardware technology era to do something like that. So the awareness and the support and or thought process that can be imputed to the entrepreneurs through the venture firms, far more important today around regulation.
And I think that's a challenge that a lot of policymakers and regulators face, right? Because it just moves so quickly, the technology, that oftentimes it's very hard to keep up and start thinking about these new technologies that are often difficult to understand and how to regulate them. And I do think that we need reforms in our regulatory system to make regulatory systems more dynamic, right? That they can adjust more flexibly to changes in technology than we have had in the past, given the pace of development.
Totally get it. And I think we're at this point, there's a very special set of issues today around generation. Because I think the regulators that are in place today largely grew up in an era where the technologies were not in their hand in the phone, you know. And I think now you have this like mass adoption in the younger crowd, like on Robinhood. You know, like, you know, the Robinhood experience with stocks is a totally different experience than your grandma loading up on stuff in Charles Schwab. You know, so by herself with no one to talk to except, you know, calling her friends on the phone, maybe. You know, so I think there's a totally different approach being taken by people that are facile with technology because they were kind of born into it. That the regulators, they don't understand the human behavior that comes with it. Hard to regulate something you totally just don't even understand or use.
Yeah, and there's a lot of research, I think, that needs to go into that on behavioral economics, on the behavioral patterns that we can observe with consumers that maybe hasn't made it into the regulatory decision-making process yet, right?
Totally true.
Let me see. I think I have some audience questions. I want to do one or two before we conclude with my final question. Let me see.
Did we get a lot of questions from the audience?
Yeah, very interesting ones, actually. So
awesome.
This is an interesting one. Do you think that NFTs eliminate forgeries or the potential for forgeries?
I think it depends on the authentication layer that goes with it.
Okay.
So now it is the case in the non-NF digital NFT world that people have found out that, these famous paintings that they have hanging in a museum were fake. So
Yeah, I know. Years afterwards, right?
yeah, so it's not you can separate the authentication and the transmission as two separate functions, right? So it's kind of like in internet, you have TCP/IP as the transport layer, and then you have the wrapper of content above, which might be Gmail, right? So someone can create a fake identity on Gmail and send you something that is a imposter. The transport layer doesn't know and doesn't care.
Right.
But it's the authentication layer that did. And so I think that parallel exists in blockchain and NFTs too.
And if you that's actually another question from the audience. If you think about that, do you think there should be one entity that can ensure that these digital assets sold by NFTs have secure ownership provenance? Like, who should do that authentication? Is it you said that there are multiple companies, for instance, that are working on that, they have different systems. Do you think there should be a common standard for that, or an agency overlooking that? What is your thought in that direction?
That's going to depend very much on what the vertical market is.
Okay.
And so, if you look at the market share leader in Dapper Labs with NBA Top Shot, they've created their own blockchain called the Flow blockchain, and the layer that's like the TCP/IP part, and then like the Gmail part is NBA Top Shot with its own governance layer that's done in concert with the NBA. So there's a very clear regulatory authority on the governance, but and in the transport layer, if something goes wrong up there, they can use the transport layer to kind of make changes as needed. If you think about another system that was like Beeple and the $69 million item that was auctioned off and handled on Ethereum, that's a little bit more open standard. The governance layer was the auction house that is identifying the item with Beeple and creating whatever certification they need around that. There's going to be hybrid cases where you have physical items that are one of a kind, like, a pair of sneakers worn by a basketball player in a game, and so I think that part of the world, there's going to be the function that bonded art warehouses play in the auction markets, where you'll have a physical entity that's bonded, insured. You take your item, you put it there, and you would buy and sell that ownership, and then they might ship it to you if you bought it. But in this case now, there can be a digital certificate and a cool 3D item that, or maybe a room with a webcam, where you own the rights to it. So you can just stream that and let people see it if you want, and it just stays there. But the ownership is represented by the digital certificate, like a share share certificate in the stock. That's basically like an NFT too on an exchange, right? I myself can't go and pick up a piece of AMD, the ownership of AMD, but I can buy the share certificate that is now digitized, and I can trade that in marketplaces that might be a Morgan Stanley marketplace on NASDAQ.
That's true. That's actually an interesting perspective on this. And so my final question is, you have been really at the forefront of investing in new technologies. And so if I had to pick your brain now, what exciting technologies or industries do you see coming down the pipeline?
I'm still, so as I talked about that series of waves, there were chips, systems, telco, expression of, kind of user interfaces on top of that telco, data science. And so I think we are still at the very, very beginning of the wave of applied data science. And I look at blockchain as kind of a subset of that, where you're taking digital techniques to essentially represent other physical items, express them to a system, and open up a marketplace that's far more efficient than it ever could have been. That applies to the outside world for things like, the items, video moments on NBA Top Shot. It also applies to every company in the world that is moving things around. So I often use the analogy, if you think about Sears, JCPenney versus Walmart, Amazon. Walmart and Amazon are NFT engines. So if you think about Sears, they just piled up all kinds of stuff and sent a buyer to Southeast Asia and said, oh, I think I can sell $20 million worth of this. Send them. And it sits in a warehouse and it goes to stores, and at the end of Christmas, maybe they have a pile of write-off. You don't know, right? In the Walmart system, every single thing is kind of an NFT. It has a barcode, and it's expressed to a data cloud like the NBA Top Shot moment is expressed to the marketplace. And the system knows where everything is all the time. And if there's too many of them sitting in a pile of inventory in Boston and a lot of sales in Atlanta, it moves. So the system has no working capital compared to the other ones with piles of inventory and far less risk. So I think what's happening today is that every major business that is not run on data where there's sort of an expression of everything inside on a data platform is going to be replaced by the companies that do express themselves in data because they are more working capital efficient, less prone to write-offs. And there's a great turnover of the Fortune 500 now, all based on data.
And I think that's not even limited to companies also, even in our own industry of research, right? I think there's so much potential for really using big data and data science that we're just starting to explore. So I think it can really disrupt a lot of the current traditional methods.
Yeah.
But this has been wonderful. And thank you so much for your time. It's been great. It's been fun to get to know your work, and thank you for your time.
Thank you.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.